Welcome to life insurance principle number 3, riders. So this can be found in Knowledge Base 2.4. And today we're going to talk about some of the basic riders that are possible on term and whole life insurance. Of course, we don't believe in whole life, but in term as well. These riders are available. And let's talk about the two that I think are okay some of the time, and that is child riders and waiver of premium. So a child rider is a rider that you put onto an existing policy or a policy written on a parent. And with a child rider, the child is insured. So if the child passes away, then the parent, whoever's on the policy, gets the money. So it's not a separate policy on a child. You add it onto an existing one, then you save a policy fee. And some companies won't even write an insurance on a child at all anyway. You have to do it through a rider, but it's better anyway. And the idea behind it is that if the child passes away, that way the parents have some cash from the life insurance policy to pay for the death benefit or other incidental expenses that come with the child passing, as tragic as that is. First thing, if a parent has, or the parents have a very strong emergency fund, I don't know if you need a child rider. Now I realize a child rider isn't that expensive. They're usually like $6, $7 a month, but it adds up. I mean, everything adds up. So I wouldn't debate with a client over it. If a client wants it, and maybe you're more of a pure term kind of advisor, and so you don't really believe in it, I kind of lean towards that a little bit myself. But I'm not going to die on the hill over that. If they want to add a child rider because they just don't, they want to make sure if something happens, they just put it on there. It's not a big deal. It's not. They're not selling them whole life insurance. But for sake of debate and argument here, one thing I do find, I think most child riders are too much. I don't know if you really need 25,000. That's the max that I know of, and that's also what most advisors and or clients usually put on the policy. Again, I'm not going to debate over it or die on the hill of whether it's 25,000, 10,000, but I would rather have the client take that extra $5-6 and put it into an investment. But nonetheless, that's how a child rider works. Some child riders, they have the benefit that when the child turns 18 or 21 or 25 or some age like that, they can then convert it to their own policy up to a certain amount of multiple. So if they got 10,000, maybe they can get 50,000 without having to go through medical. That's a whole nother mixed bag too, because what 18-year-old child really needs insurance at all? And the trick is if they don't convert it right away, they can't convert it 5 years later. So it may sound like a great benefit, but the truth is, by the time most children are eligible for the conversion, they probably in most cases don't need insurance anyway. So just get your own insurance when the time is right. So that's a child rider. I think that's okay. The second one is waiver of premium. This one is okay to do if the client has a career or job where there's a realistic possibility of them becoming disabled at work, because what it does then is it then in most cases they have to be disabled for 6 months, has to be documented and officially disabled at work, and then they will the company will pay the policy premium for them till the policy runs out. You're basically saying, I'm going to give you a little bit extra money, a couple of bucks a month. I'm going to give you extra, you the client, to the insurance company, and if I get disabled, which of course will reduce my income, I'll probably get some kind of disability insurance, because if I'm in a career where there's a high odds of me getting disabled, I'm going to probably also have disability insurance, or the company will have it. Either way, the point is my income will probably go down, right? Even disability is not going to pay 100% forever. So, but what you will do, insurance company, is you will then waive my premiums, hence waiver of premium, because I'm not disabled. I've been selling insurance for 30 years. To be fair, I haven't sold a lot of it probably in the last decade, or at least, let's say, 8 years. But I sold quite a bit in those first 20 plus years. One time have I had a client ever use disability insurance. And by the way, that was when I lived in Maryland, and there was a client that was in West Virginia that literally worked in a coal mine. No joke. Literally worked in a coal mine. So, you got to ask yourself, what's the chances of this client's having an occupation where they're going to become disabled? And if they got to be disabled for 6 months. So it's not just like a quick, I twisted my foot working at Walmart or whatever, and that is disability, but it's got to be a sustained disability. So The problem with all these riders is if you look at each one individually, they're usually very inexpensive. Child rider, waiver premium, and other ones we'll talk about. But what a lot of insurance agents will do, most advisors don't do this, but most many insurance agents, is they just add them all on. And after a while, it's like, pennies start adding up to dollars, and nickel and diming, as they say, is kind of what happens. And I see that with the whole life, especially. They'll add, this security blanket on child rider, add a waiver premium on, and some of the other ones we'll talk about. Let's go through a couple other ones. So these two, I wouldn't ever call them rip-offs, but I would just say be careful about when you use them, child riders and waiver premium. So we've got a couple other ones: accidental death, paid up, participating, dismemberment, and increasing benefit rider. Some of these aren't really riders; they're just features that a policy has or doesn't. And some of them apply only to whole life, some of them don't. So accidental death. Accidental death basically means if you die in an accident, then we'll pay you double. So if you get a $100,000 life insurance policy and you add an accidental death benefit rider, you pay a little bit more, just like all the other riders. And then the insurance company, if you die in an accident, you will then get 200 instead of 100. Never made sense to me. From day one that I heard this, I was like, it doesn't make any sense. First of all, most people past the age, I used to know the statistic by heart, now I don't, but it's something like past the age of 25, the majority of people that pass away don't die in an accident. Right? It's not an accident. It's medical, act of God, what have you. Okay? So it doesn't even apply. But more importantly, even if 50% of the population, 50% of the time, at any age bracket died of accidents, which they don't, but if they did, it still doesn't matter. What I told clients when I explained, I said, look, just get the insurance you need. Do you need 100 or 200, right? Because the policy is 100, the accidental death is 200, and you seem to be excited about it, or the other agent's making you excited about it. So which is it though? Is it 200 or 100? Because the method of passing away does not change the amount of money your family needs. Either your family needs 100, they need 200, right? The way you die doesn't change the needed death benefit. Let's just figure out what your death benefit is using our calculator, and then let's figure out how long we need it, right? The length of term, and then we'll just get you that. If you can't afford it, then we reduce one of the two or both. We reduce the face amount, or we shorten the length of term. It doesn't, right? And we'll cut all the riders off, by the way, because by the way, those riders add up, right? The accidental death and child rider and all the other things. Well, those couple extra cents, like I said earlier, you could invest the difference, but also why not just apply it towards face amount? So if you take all these riders you will potentially be buying, maybe that'll save you $10 a month. Well, $10 a month, maybe that'll get you from 100,000 to 130 or whatever, right? So that's really the biggest argument for me against accidental death. It isn't the ratios and the percentages and the odds. It's that you're going against the whole idea of getting the face amount you need. If you need 200, don't get 200. Don't get 100 and hope you die in an accident. If you need 100, don't overpay and hope you die in an accident to get 200. Just doesn't make any sense, right? So, paid up. Paid up is only applicable to whole life insurance. Kind of, you can do. You actually can kind of do it with some term policies in a way. It's kind of return of premium. You can kind of finagle it to make it act like a paid up at some point. But here's what happens. All paid up does is it's a rider you add, and you overpay your premiums. Again, this is really 99% of the time applicable to whole life. In a whole life, you're already overpaying, right? But now you're overpaying. And that extra overpay will at some point make the policy paid up, which means you stop paying premiums and the face amount will keep going until the end of your life. So it's basically, if you think of whole life, it's very simple, right? If you're 30, you're going to pay from 30 to age 100 the same premium. And, sorry about that. That was a Pixel, a cat, jumped in and she was not very excited about paid up. She's like, this is even the worst. It is the worst. So if you got age 30 to age 100 premium, age 30 to age 100 face amount, right? And the premiums are calculated. The insurance company's got all figured out. They got it calculated that even though your odds of dying go up, which means they have a higher chance of paying out to your beneficiaries, which means higher risk for them. They've evened out the payment, so it's the same payment all the way through. Okay, it's not the same risk to them, but to you, it's the same payment. All they're doing is taking this 70-year time frame in my example of 70 years worth of premiums, and let's say that they're offering you a paid up rider that says, hey, if you add this rider and you pay X amount more, then by 70, or let's say 65, by 65 you stop paying. So instead of paying from 30 to 100, you're paying from 30 to 65, but the face amount goes all the way to 100. All they're doing is taking the premiums you would have paid from 65 to 90 and throwing them in here. Now, it's not dollar for dollar because they take into account compound interest and all that, but basically the value of those premiums, you're just prepaying. It's like, and you would never do it with another product. You would never go to AT&T cell phone service and say, I got unlimited for $50. And then they go, well, but if you pay 110 instead, 10 years from now, we'll give it to you. We'll give it to you for free forever or something, right? Whatever the numbers may not match up, but you get the concept. You wouldn't do it because you don't know what's going to happen in 10 years. First of all, you're like, I can use that extra $50 now. Plus, who knows in 10 years if there's a better carrier, a better whatever. Same thing for life insurance. You're just prepaying it and giving them the money. If you want, you could actually mimic that by just taking the difference in the premium payment and investing it. And then by the time you're 65, use that invested money to pay the premiums from 66 to 100, and you'd be better off. Because it's mathematically impossible that the insurance company can do better than a mutual fund. Always remember that, right? There's no magic. It's just math, right? Math is math. Okay, participating policy. Participating policy, again, usually whole life. I've seen some terms, I don't know if they exist anymore, but years and years ago, they had participating. What it means is that the idea, what they're selling to you is like a stock. Ownership. And they're saying that every year the company is going to pay a dividend to everyone that decides to elect and pay for, well, they don't know they're paying for, but if they elect to get a participating whole life policy, it means that you, the client, will get annually, you get dividends back from the insurance company as though you're an owner of the insurance company and participating in the profits, and they'll throw it back in your policy either as a cash value or reduce your premium for next time frame, right? They don't send you a check. Funny thing is my car insurance company does that, USAA, which is a great insurance company, but that little feature is a scam. Look, all they're doing is charging you more and giving it back to you. So imagine you go to a grocer and every day you buy an apple for 10 cents. And one day he charges you 12 cents. You're like, why? So it's participating. What I'm going to do is I'm going to charge you 12 cents, but then every day when you come back the next day, I'm going to give you 1 cent back. Well, if you didn't know any better, maybe you're a new customer and you came into this store after he started this process, this policy, you'd be like, this is awesome. Every day I buy an apple, if I come back the next day, they give me 1 cent back. Well, yeah, because the apple actually, the retail cost is really 10 cents, but you're paying 12. He gives you 1 cent back, and you think he's a hero because you don't know any different, that it really only costs 10 cents. The retail cost, not even his pure cost. Same thing with participating. All you're doing with participating policy is you're paying more. It's not a rider. It's like this policy is a participating one, but I guarantee you that company has the exact same policy on their shelf that's not participating, and everything else is exactly the same, except the premium is a little bit more in a participating one, but they give you money back. Here's the easiest way I can tell you to prove to you that participating is a scam. The IRS does not charge you taxes on the quote-unquote dividends that you're getting back. Why? Because it's not a profit. They're collecting more from you and giving it back. Okay. Again, if you're not going to buy whole life anyway, which we don't think you should, this is kind of a non-issue. I think it's just more that it's better that you just learn how this works, especially if you come across a whole life policy and have some of these riders you can explain to them, because it does is it kind of digs the hole a little bit deeper against the insurance company and against the other agent. Look what they didn't even sell you pure whole life insurance. They added a child rider. That's okay, kind of, but they added a waiver of premium and you work at a desk job. They added a participating. They added accidental death, all that. Paid up, what have you. Dismemberment. Dismemberment is basically a little bit like disability. If you become dismembered, and they got a whole list of how that is. I used to know by heart, but it's like, this arm, this leg, and that kind of thing, dismemberment. The idea is the same. It's got to be a dismemberment that prevents you from doing the duties of your chosen career, something to that effect. It's the same nonsense as waiver of premium. But if you're going to get it, because maybe you in fact do have a high-risk job, physical damage, high-risk job, then just get disability. Just get pure disability that covers all that stuff. Don't get dismemberment for your left arm. Okay, it's stupid. And then the last one's increasing benefit rider. This one is, as far as I know, unique to Primerica. It may not be. Insurance companies try all kinds of weird stuff and then they get rid of it and they add it. But this is one that's with Primerica. And so I'll still talk about it. And what the idea is, it's increasing benefit rider. And the idea is that it's like the opposite of decreasing terms. So your term insurance face amount will go up over time. So if you get a 10-year term, 20-year term, 25-year term, 30 or 35, or whatever the case is, it goes up. Now, it doesn't go up forever. If you get a 30-year term, it doesn't go up for 30 years. At the top of my head right now, I can't remember how long, but I think the max is, I think it's 10. I think regardless of how long the policy is, it goes for 10 years. And there's some good and bad. I wouldn't call it a scam. It's probably the best of all the riders that we've talked about today, except Child Rider. Child Rider is the most valid rider there is, but it's probably number 2 after. But I still don't like it. Here's why. So the way it works is the idea is that, hey, get this increasing benefit rider, and your face amount will go up by 5% or 10%. You can choose which one every year. It's to fight inflation, the higher cost of living. Before I get into the mechanics of it, the problem for me is it goes against the philosophy of theory of decreasing responsibility, which Primerica itself espouses. So look, either your responsibilities decrease or they increase. Pick a plan. Pick a philosophy and run with it. Don't play both sides to try to make the sale. So when you're selling term insurance as a concept, you're espousing reducing cost, reducing need for life insurance, right? The theory of decreasing responsibility. But then when you want to add this rider, because of course you get paid commission on it, now you're espousing increasing costs. There's debates for both, but pick one. Because if you're talking increasing costs that don't decrease, then frankly you should be getting a term to 100, right? A term, a whole life type term. Not whole life insurance, but a term to 100, which of course Primerica doesn't have that product. But you should. That's what the client should go look for in an open market, if you believe that. Okay, I believe in theory of decreasing responsibility. I think that inflation and a rising cost is true, but it doesn't. But the reducing cost, the reducing need. Sorry about that. Pixel's getting on my way again. But the reducing need for life insurance is greater than the increase in living expenses in regards to life insurance, right? Because your mortgage starts getting paid down, your car payment gets paid down, student loans, if you're young when you get life insurance, get paid down, your kids get older. Those things far outweigh inflation, okay? So, but let's just go with it. Okay, great. Client says, yes, I want to have an increasing, some of the way the agents sell it is, well, it only increases for 10 years. Actually, it increases 9 times, right? You get your policy year 1. Oops, sorry about that. The mic is moving on me here. So you get the policy at 100,000 year 1, and year 2 it goes 110, 120. It's a simple interest growth. It's not a compounding. And then it goes to 10 years, and then it's going to then the theory of decreased responsibility kicks in. So they'll claim that, well, when you get the insurance right now, for the next 10 years, maybe the needs will go because your mortgage isn't going to go down much. But that's a very generic statement. What if the client is 50 already when you get the insurance and they're already halfway through their mortgage? So the point is, but here's the benefit. Here's the benefit of it. Though I think the philosophy is wrong, so I would never buy it. But if I needed it or wanted it, here's what's good about it. What's good about it is, one, it's automatic. Right, so every on the 13th month and every 12 months later, it's going to increase the face amount by 10%, simple interest, and then the premium goes up accordingly. But the cool thing is, one, there's no medical. Actually, there is, but I'll mention that in a second. But there's no medical in the 13th month and in the 24th month and so on. You don't have to go through medical again. So maybe you got sick in the meantime, okay, in those first 10 years. 2, it's automatic. So there's no thinking involved. This happens automatically. Number 3, the benefit is that this is the biggest benefit, is that the cost is based upon your age when you bought it. So if you buy it when you're 30, it's a 20-year term, but for 10 years, it'll go up by 10%, right? So it doubles in 10 years, right? So if you get 100,000, it'll be 200,000, then it'll stay level for the remaining 10. Well, the benefit is that in years, 31, 33, 35, 37, 39, it'll be based on your age at 30. So it's based on your age that is when you bought the policy. Because if you manually call, 5 years later, if you manually call them and say, guess what, we got a new kid and we want to get more insurance, you could either add a more insurance on or get a separate policy. Well, either way, that extra insurance is based on your rate at age 35, not age 30. Okay, so that's good. But here's all they're doing. To me, it's a little bit like paid up insurance, like whole life paid up. It's a term version of paid up insurance, but instead of paying up The premiums, you're paying up the face amount. What I mean is, when you understand what's going on behind the scenes, it's actually almost a little bit like accidental death. It's almost a little bit like accidental death, which is, so using my numbers, 100,000, you buy it, it's going to go 10% simple interest for 10 years, then it stops increasing, right? So it's 200,000. All they're doing is, when you buy the policy, they're doing underwriting for 200,000, right? So when I say there's no medical, yeah, there's no medical later, but you got to pre-qualify. For whatever reason, the insurance company would not insure you for 200, but they would insure you for 100, you can't get this rider. If you submit it and the insurance company declines at 200, so in other words, you have to qualify for it. And by the way, that does happen. At 100,000, 200, probably not. But let's say you got an original policy for $1 million. And you do this increasing benefit rider, which means in 10 years we'll go to 2 million. That can happen. There's definitely situations where your medical is right on the edge, where you would qualify for $1 million but not 2. Or it's not just qualify, not qualify, rated. If the insurance company says, okay, we'll rate them at this level at $1 million, but at 2 million, we'll still cover them, but we'll rate them higher. If that happens during underwriting, the rider doesn't work. So the point just is that all you're doing as a client is you're getting yourself pre-qualified for double the amount. But then the insurance companies, it's like in reverse. So you're really getting, let's go back to 100 and 200. So you're really getting $200,000 of coverage. But what they're saying is, we'll let you ease into it. We'll only charge you $100,000 in the first year. Then we'll charge you for 110 in the second, then 120, then 130 until you catch back up. But you're not prepaying it, to be fair, but you're pre-qualifying for it. So I go back to the same thing I say about accidental death. Well, which do you need? Do you need 200 or 100? Which one do you need? Just get that. And then subscribe to the theory of decreasing responsibility, and odds are it'll go down. Now, things change, I get it. You do get new kids, or maybe you move into a larger house, or somehow you take on more debt or something. Of course, but you can't, no matter what insurance you buy, you got to do the snapshot version. That's what every financial advisor will tell you. Do a snapshot version of your finances and go with, just like when you get a car. Right? You're not going to insure your car for, a Tesla Model S for $150,000 if you're driving a Hyundai for $25,000. But might you get a Tesla later? Yeah, but then worry about it then. You're not going to prepay to get in early, right? It's stupid. So a lot of this stuff, if you just got to understand the concept of the philosophy that's going on there. So that's increasing benefit rider. So anything, really, I almost want to lump those three together. Paid up, increasing benefit rider, accidental death, all this stuff, they're kind of finagling prepay, pay early, or discount now. Just nonsense, right? The whole reason that term insurance, not the whole reason, but one of the reasons why term is so awesome is because it's simple. It's simple to understand. It's simple to buy for the client. It's simple to sell for us. It makes sense. You can explain it in a couple of minutes. You pay this. It's a fixed cost from here to then. You get this face amount. It's a fixed face amount from here to then. And if you die, no matter how you die, no matter where you die, unless it's suicide in the first 2 years, your family's going to get the money, man. There's no increasing, decreasing, prepay, late pay, none of that nonsense. So all these riders always, like I say, except maybe child rider, maybe waiver of premium, everything is it's all just smoke and mirrors and games. It's like, so that's really the third principle. I'm sure somebody somewhere can come up with an exception where this was better, or it's just like the old thing about seatbelts, right? The people that are getting, and nowadays no one is, but even when I was growing up, it was still this, I'm not going to have the government tell me I got to wear a seatbelt. And everyone's got a story about someone they knew that heard about a friend that had a neighbor that knew someone that got in a car accident without a seatbelt, and they got launched through the window. Other than scrapes, they were okay. And they'd think that if they had a seatbelt on, they would have been crushed and killed, right? So probably some agent somewhere, like if they saw this video, would say, nope, I had a client way back over here that had a friend who was a client, and they said that their dismemberment, it's like, you got to play the odds, right? So anyway, that was it. I hope that helps. And if you have any comments, thoughts, ideas, questions, hints, tips, please feel free to respond.